in public markets, there's not a lot of difference between the best and the worst. But as we move into markets like venture, that's where there's a lot more opportunity to get outsized returns.
Bottom quartile players actually tend to have negative IRRs.
So in other words, a quarter of the managers deliver all the returns and the rest of them are terrible.
Maxwell, I've heard you say that this may be the best moment in lifetime to invest in these. Can you talk about why you guys think now is the moment for early stage venture?
Patrick Dwyer and Greg Poole here from NewEdge Wealth today to talk about venture capital. And with us today, we have our CIO, Cameron Dawson, who you may have seen on television, and then Maxwell Snyder, our head of alternative investments, who is deep in the weeds in the tech community in San Francisco and New York. So we're really delighted to have you both here. We're going to have a really exciting discussion today. Greg, why don't we start with you?
Yeah, well, I just wanted to talk a little bit about why we think seed and early stage venture and why the fund that's been put together here at NewEdge is so exciting. I think, one of the things we frequently talk about is beta versus alpha. And we say that for something that is beta, you want to not pay a lot of money and you want to keep it really simple. And you want to save your fees and your complexity for something that is really different and or better. And we really think this is an area that really is. And when I think back to my experience in public market investing, I'd say seed and Series A early stage venture investing really does remind me of some of the inefficiencies I saw 25 years ago, when you would go meet a company at a conference and they would tell you this amazing business they have. And you were like, really? And you would go buy the stock and it played out and the stock went up. And as you know, we believe most of those inefficiencies in the public markets are gone, but we really think here they exist. And so we thought this would be a great opportunity to talk to two folks who know a lot about this.
Absolutely. And not only do they know a lot about it, but Cameron and Maxwell know the players in this space personally. The players in this space are younger, and Cameron and Maxwell, they're their peers, and they really know them. And increasingly, when I come across some of the best technology entrepreneurs in the United States of America, and we're trying to do business with them, they already know Maxwell and they already know Cameron, which gives us a unique advantage of getting access. Cameron, I'd like to just start off with just asking you in general, when you're looking at someone's asset allocation, tell me about where venture fits in and why.
Yeah, it's such an important point because oftentimes people approach the asset allocation question of saying, give me one of everything. And we don't think that that is the right approach. And we really have to think about how we build portfolios, the function that each asset class plays in the portfolios. So Greg mentioned this idea of alphas versus betas, and this idea that in public markets, there's a lot of information, which means that there's not a lot of difference between the best and the worst. And that's just beta. It's what you get by the market. It's a great way to get efficient, cheap exposure that really has that simple side of things. But as we move into markets like venture, where there's a lot more dispersion between the top and the bottom parts of the managers, that's where there's a lot more opportunity to get outsized returns if you can be at that top portion of the manager selection. We're going to talk about that more in just a second. But when we then build this venture allocation into portfolios, what we're trying to do is capture that ability to get outsized returns. And what drives that outsized returns is the isolation of something that we would call the innovation factor. One of the things that makes the American economy so very dynamic is our ability to innovate, to invent, to come up with leading edge technologies and create businesses that are dominant global leaders in all of these new platforms. And we think the most exciting and also the largest return potential is by focusing on those companies that are at the leading edge of that innovation. And so what we're doing is we're saying, we don't want to care about what's going on in the rest of the economy. We don't want to think about what the Fed is doing, what the S&P 500 is doing. Instead, we want to isolate innovation. And the best way to do that is through venture investing, mostly on the seed and very early stage. So think first check to a business or second check to a business as they're starting to develop this exciting new technology. So being able to have that isolation of venture really is what gives the opportunity to be able to generate that outsized return, get that alpha that Greg was talking about, and add to the overall portfolio returns for long-term investors.
And just quickly, when we talk about an outsized return, I just would like to just sort of define like expectations that investors should have, across the investment spectrum, going forward, right? The past is the past. Like things that had huge outperformance when rates were zero, that was a different environment. We're in a different environment now, and returns are going to be different. And if you're looking at stocks, 8%, kind of like what you're looking at on equities over a long period of time, maybe 7 after tax. If you're looking at, private equity numbers, they're probably coming down. We think they're more like, 9 to 11 is where they're going to be in large private equity, because that's a more mature space. And in venture, the returns can be really wide, right? Like there's like a huge difference between the top and the bottom in venture. And we're talking about early stage venture, not late stage, which we can discuss that later. Would you, Maxwell, just kind of like, what would be return expectations? Obviously, every vintage year is different, like high lows in that space.
Yeah, so I still think at the top quartiles, we're shooting for 20% plus IRRs on a consistent basis, and, well over a 3x net from a fund basis. When you think about kind of where that top quartile plays. Now, I will say that rapidly declines as you move down quartiles towards that bottom end, as Cameron was mentioning. Bottom quartile players actually tend to have negative IRRs, at least over the last 25 years, right? Representing a pretty wide delta, almost 25% as we think about kind of that top quartile to bottom quartile spread.
So in other words, that basically a quarter of the managers deliver all the returns and the rest of them are terrible. Basically, that's real. That's true. And
you better be with the right managers.
You absolutely have to be. So let's just frame that up for a second, because I really want people to understand this. Let's explain the power law. If you're going to invest in venture, what are the things you have to do over a long period of time to have a shot at having those kind of returns, right? Because what we're really talking about here is playing probabilities, right? And how do you play the probabilities to get that return?
Yeah, so I think the most important thing to note there is really this thing that we've been talking about for a long time now, which is manager selection, right? The goal here is finding groups that on a consistent basis have not just been able to find the right companies, but have actually been able to build the right companies. And this is really where we really get to this idea of how does information advantage affect your ability to invest in companies, sure, but also to help those founders build the next generation of category defining companies. And what I mean by that is really we are looking for venture funds where on a consistent basis, founders have turned to us and said either our company might not exist without this investor. Our company would not be where it is today, absolutely speaking, without this investor. But on top of that, more consistently than not, it's a founder who turns to us and is able to say, look, this is the investor that I turn to when we have something that went wrong in the business and we need a real third-party objective view. And this is the group that we trust to give us one, because the advice that they've given us on a consistent basis has led to really spectacular outcomes. Right. And so it's really about identifying and isolating this factor about this relationship and the power of the investor and their ability to be the back to founders and to provide that kind of sounding board, as well as, sound strategic advice from a third party.
So could you just define, guys, for me, typically what is the size of that fund? Tell me the size of the funds we're targeting. How many funds have they done? Describe to me what that looks like.
Absolutely. And so really important to note that your returns, at least historically speaking, have come down pretty meaningfully in terms of your opportunity for meaningful outperformance as you scale up in size in the venture business. And so really what we're looking for is what I'll call small funds by an institutional standard. So call them 75 million to 200 million in average AUM. Now, there are some cases where we've gone a little bit above that because we think that the investment rationale and the sector that they're focused in warrants having a larger amount of capital, because the things that they're going after are things that require a significant amount of capital. I'll talk a little bit about that partitioning of capital light and capital efficient businesses more extensively as we get into the thesis. But the idea here is really to recognize that there's a right size of capital vehicle for the right size of business and right opportunity set. And as founders become more and more efficient, as their businesses are able to be more productive and build more operating leverage within their models, The way they think about taking in capital changes meaningfully. And, one of the things we really highlight is this idea that capital is very much a signal for interest and alignment now, more than it is the actual point of the investment, because capital has become so commoditized as more and more money have chased fewer and fewer opportunities.
Here we are talking about how fantastic venture can be in a portfolio, but it comes with all these caveats that it's hard to find the right managers, as well as to get access to those managers. And usually they have huge minimums. And so you have to do a lot of work to solve for those challenges. So on the access front, you have to have the network. As you talked about, Pat, we talked to everybody on the street. Maxwell has an incredible network in order to get an idea of the early stage people, funds starting and really getting embedded in not just the funds themselves, but in companies. You also have to have the resource to be able to do the due diligence. To isolate the top part decile of managers, you have to have a very deep team that can get to know these funds, do the deep due diligence. It takes a lot of intellectual manpower in order to be able to do it. The last part is that you have to have the flexibility to do smaller funds. You have to have the flexibility to find these early stage funds that are on the leading edge of things. Because what we've seen is that as venture has matured as an asset class, the funds get bigger and bigger and bigger. And what happens is that the returns, the alpha that they used to generate, starts to wither away. So what we're trying to do is find, almost being like venture people ourselves, finding these new and exciting funds that are still at sizes that we think that we can get the alpha. That means that we have to have the resource. We have to have the resource to do the due diligence, and we have to have the network of access in order to be able to accomplish that.
So in summary, what you're really saying is, the asset management business of venture is no different than any other asset management business. They want to make them bigger. And so you have to kind of avoid the funds that have scaled up and become, they're trying to become the Blackstone of the space. And you got to stay with smaller funds if you want to have outsized returns, right? If you want to have outsized returns, that's what you have to do. That's it. There's the only way to do it. The big funds don't have outsized returns.
And it also means you need diversification. And diversification can be difficult in venture because sometimes the minimums are so very high. And we're going to talk about structuring in just a second of what we've done in order to solve for those challenges in structuring this venture opportunities fund, because that really is what's unlocking the possibility, what's unlocking the capability to not only get access to these managers, but to get it in a diversified way at a minimum that's attractive and with a fee structure that's extraordinarily attractive.
I just highlight on top of that it's important to note that diversification goes both ways, right? You can diversify out alpha pretty quickly in this area because of the number of zeros you have. And so if you have these really large multi-billion-dollar funds, right, that say they're focused on seed, pre-seed, Series A investing, by definition, they have to do pretty much everything, right? Because to even get to the point where they have a significant position, they need to do 4 rounds of investment where they're leading those investments. Right. And by definition, that means that the majority of their capital are going to be these starter checks into businesses that will likely fail or be acquired by their larger counterparts. There's nothing wrong with that. It's just a recognition that it's more of an aggregation game for some of these really large names or acquiring targets for these large names, more than it is saying, hey, we're going to start from zero, right, with a business that we think will be the next, category defining technology.
Obviously, we want to get into the details of the fund. I'd love to start a little bigger picture. I mean, early stage venture is something that we've all liked for a long time. But, Maxwell, I've heard you say that this may be the best moment in, lifetime to invest in these. Can you talk about why you guys think now is the moment for early stage venture?
Absolutely. And I'm sorry to bore you guys, as I know you guys have heard me go on and on about this. I really like to start with this idea that the tools that are available to founders as they start at the very earliest stages of building their businesses are fundamentally different and enable fundamentally faster growth than ever before in all of history. And yes, that involves some of the tools that we're seeing with AI. That doesn't necessarily mean businesses that are building AI tools, I want to be clear, but finding new and innovative ways to use them across a stack, which is replacing those kind of first moves towards labor that used to be really significant headwinds as people thought about building out their businesses. This idea that, instead of having to hire 4 really talented engineers on day one, you can hire 1 really talented engineer, give them an unlimited number of credits to go after something like Cursor or OpenAI, and have them produce the same or even sometimes better quality work than you would have had having 4 disparate coders who, were just finding the right groove and finding ways to work together. And these new set of tools have allowed founders not just to get to revenue faster or to earnings faster, but also rethink how they think about capitalizing their businesses, how they think about building out that base layer of technology, how they think about partnering. And it's really changed the landscape and continues to change the landscape in how we think about what's required to build a business at the earliest stages. Right? What do you actually need from an individual perspective or from a team perspective to have in order to do that? Right now, we're sitting at a point that is really phenomenal in that we are seeing people build, one-person businesses that are getting to tens or hundreds of millions of dollars in revenue relatively quickly. We're seeing businesses get from time to earnings, down from almost a decade to just a few years, time to revenue compressing even faster than that. I think what's really changed here is that on a fundamental basis, founders can do a lot more with a lot less. And it's allowed them to think about how they build their businesses in a very different way. And by virtue of that, we think that the way those businesses will be capitalized is going to change along with it. I think a lot of this comes down to something you'll hear us talk a lot about, which is this is a founder first concept. Right? The way that we're investing is about enabling founders to build better businesses faster. And really, that's what this vehicle and this investment style comes down to, is that we think that there's a unique change that's happening right now. And we think there's a great opportunity to partner with the people who will be the largest beneficiaries of it.
Thank you, Maxwell. That was great. In summary, what you're really talking about is this is an incredibly unique time because AI tools are allowing early stage venture rounds to be done with less capital, less people, meaning that you can have a bigger financial outcome, right? This is what's happening is we're getting efficiency in the early stage part of the space is where your opportunity to have an outsized return is bigger. Put it really simply is when you're investing in pre-seed, which you don't have a pre-seed, you have an idea, seed, you have some revenue, you're starting to rock and roll. That's where we want to be putting capital in. That's kind of the value side of investing in venture. Also means we got to wait longer to get our money back, but we think our odds of having a better return are good because we're investing when it's riskier, it takes longer, and when the valuations are lower. So Maxwell, was that the right way did I characterize that correctly?
Yeah, I think that was the right way to think about that. The other thing that I'd add there is it's really changed the way that we think about acquiring businesses and really what's going on in the M&A market. Because as founders are able to get to earnings faster, the way that their buyer universe changes is meaningful because they become accretive acquisitions, right? Acquisitions that actually help you increase your earnings power as opposed to being a cost center for years to come. It's something that's really changed on a fundamental basis how people have thought about when you do M&A activity and why you do it. With things like Mosaic ML being bought out of their Series A at $1 billion valuation by Databricks, really on the back of saying, listen, we recognize that this business is moving quickly and going to get to earnings fast. We also recognize the benefits of having that within our ecosystem. And so you're seeing these kind of M&A transactions that are transformational for the businesses that are not AI native, if you will, really become a kind of key focal point and really a great exit opportunity for early stage businesses that may not want to go the distance of going public or to becoming a larger business themselves.
And you can make this contrast between early stage businesses and what we would classify as later stage growth, which is that the later you get in the maturity cycle of the company, the more sensitive it is to the overall economy and the overall market cycle. So you think about the experience of the last few years coming out of COVID and coming out of the downturn we had in 2022, the IPO market since 2022 has been effectively frozen. That means that late stage growth companies have been just getting stuck within these portfolios. And what we're finding, though, is that the earlier stages, because they're less mature companies, because they're still in these hyper growth stages, they simply are less sensitive to what's going on within the IPO market. And that's really powerful when we're building portfolios because we can get access to overall economic cycles and overall market cycles really easily, really simply through things like direct indexing. But to get to that early stage, that's why we have to focus on things that don't have that same kind of sensitivity have this ability for outsized returns and allow us to, again, get back to this idea of isolating innovation. And the only way you can really do that is by focusing on those very early stages.
I think one of the things that people don't really understand is that what's happening today is every single sector of the US economy now has venture capital building customized tech for it. That has never happened before. And it's because you can do it, because it doesn't cost as much to do. That's why they're building this. It's because the cost of building software is plummeting. It's like dropping every day. And so that's what's incredible about this cycle. Things you couldn't afford before, you can now afford. And every industry is building brand new AI verticals, which has every player in every space in a panic. So the traditional players in this space are now looking at these startups and saying, do I have to buy one of these to survive? And the startups that are a little farther along, that maybe started 5 years ago, they actually are behind some of the new startups in some new areas, and they're reversing and buying some of these startups. The way people are going to make money in venture the next 10 years is going to be a lot of venture companies buying venture companies. I think there's going to be a lot of that because you got to go really fast to win right now. And companies are going to buy rather than build because they may not make it building. It's too long. It's too long for them, especially incumbent players in these spaces. Incumbent players right now are beginning to panic, and because ventures like building, there's armies of companies coming into every one of these spaces to disrupt. I mean, think about like the credit card space is a new hot space for venture. There's all these new credit card companies coming out. And so imagine you say, well, how could that work, right? Well, every neobank probably needs to buy one of them. All the traditional banks that don't have successful products can buy these things. There's so many ways it's going to be such an interesting market, and there's going to be a lot of non-sexy ways that people make money. We're not talking about like owning $7 trillion exits. We're talking about like there's going to be a lot of like triples and things like that happen in the space.
Yeah, I think that's definitely the right way to think about it. I also think it's worth mentioning it, and Pat, you touched on this a little bit. There's this incredible amount of labor debt in the system at a lot of these technology businesses. You're starting to see it as some of the big groups that, Facebook and Microsoft start to do larger layoffs, right? But I think it's a recognition that if you started your company 10 years ago, the tools that were available to you required a lot of manpower to make them work for you. Now they don't. And the truth is that these young businesses are saying, yeah, we can do the same thing that, Canva can do with 9 people in the garage and have it be way more intuitive and work essentially, as well, if not better. And we can drop the price to a third of what they offer because we have 9 people in a garage, not 6,000, right, in a, Palo Alto superstore, so to speak. And I think it's just very important to note that, there's this kind of meaningful shift that's happening where people are saying, hey, maybe we can go back to building companies where we try and have fewer people and fewer layers between us. And that, I think, is something that really has changed how people think about kind of conceptual organization of their businesses, as well as what they're doing from a technological standpoint as they think about building them.
From a capital perspective, an easy way to explain this to investors is one business that I'm familiar with, like $1 million has been spent in this startup to 3 people, really 3 full-time employees, and they got to $400,000 in recurring fee revenue, $2 million total, but recurring fee revenue in like 24 months. So think about it. If you invest $1 million and you can get 400,000 in recurring fee revenue in 24 months, and you're growing like a hockey stick, like that just did not happen before. Like if you could invest in a financial advisor, pay $1 million, and he would generate $400,000 in revenue 2 years later, that'd be an incredible trade. You'd be doing that all day long. And with like hockey stick growth afterwards. I mean, and so now you can do it in companies. And it's because ultimately what we're really not saying is companies want to buy this software and they're totally open to it in a way that they were not before. So imagine, this is part of why we're talking about this is if you go back 4 years ago and you walked into a major corporation and you're like some little startup and you say, hey, we have the software that can save you, $10 million. And they're just be like, we don't care, right? Now they're going, we want to talk to you because they're scared that if they miss it, they're done, right? And so all of a sudden there's this openness to it because every company realizes that their cost structure is going to get doged. And so this is essentially the doging of every industry in the United States. The efficiencies are coming. And so you have receptivity from buyers, right? They're very receptive and they're willing to take risk by trying these new products because they have to.
Yeah, absolutely. I think the other thing to mention there, and it's something we've talked a lot about, is just this idea that like we're talking about is a step function change in labor productivity, right? Not to bring it back to Keynesian economics to some degree. I know Cameron will get a kick out of this one. Just really this idea that we haven't seen a situation where, fundamentally speaking, labor productivity shifted in an incredibly meaningful way across virtually every single area simultaneously, since arguably, you could say the internet, you could say Adam Smith division of labor, and the Industrial Revolution, right? But I really think what you're talking about is everyone is realizing that you can actually do a lot more with less. Yeah. And everyone's realizing it at the same time. And it's very rare that a bunch of industries and a bunch of people within those industries all simultaneously say, oh, what used to require 6 people and 4 systems requires 1 system and 1 person. And it is really, I think, something that, there are going to be lumps here as we digest that. It's going to take time for us to work that into workflows more efficiently. But I do think that what we're talking about here is an opportunity to invest in businesses that will just fundamentally be more efficient in virtually every way, whether that be time to product, whether that be time to market, whether it just be the fact that you used to have to launch, a consumer facing beta and a developer facing beta separately, right? And now you can launch one beta and have it be very efficient. And there are so many ways to think about this on a fundamental basis, but I think it just comes down to this idea that everyone realizes how much more is feasible.
Maxwell, one of the really unique things about NewEdge Wealth is Cameron and Maxwell. I mean, you all have, getting access to the space is very difficult. Big firms typically can't really show these types of funds to people because they have to, they have too much AUM to move. It's the kind of thing that an RIA is really good at bringing. Maxwell, talk about your network, how you know all these folks, how you meet them, how it actually works, the socialization, all of that, which is a huge part of venture. Like venture is about who you know. I mean, it really is.
Yeah, so I think a lot of it comes down to this idea of founder first and being helpful, which I think are 2 things that are kind of tenets of the ecosystem that we built here. Right. One is how can we help founders, whether that be, with financial planning and stuff that they're doing outside of their business, or whether that be with thinking about how to grow and work through their business strategically or build partnerships. And I think what that's allowed us to do is really build these incredibly strong relationships with founders and with funds where we really do get a peek behind the curtain. Right. And what that actually looks like are intros to people that are very hard to get introductions to. Real sit downs and real and candid conversations with people who are at the cutting edge of industries where they will turn to us and say, look, I don't think this is going to work. Right. Which is almost as important as saying, I think this is the next great thing. And it's this idea of being able to turn to really a congress of peers who are all building in their own rights, who have all been through experiences at varying levels at various times, are on various paths, and really get a consensus view from a truly knowledgeable basis of peers around any of the investment opportunities that we're looking at. Whether that's the ability to, call the Vise team, Samir and Runik, when we're thinking about with wealth management tech, we're thinking about operationalization of things like indexation, or whether we're talking about things, more practical around biotech with groups like Catalio that I've invested with for almost a decade now, or whether that's really just the benefits of being in the right rooms at the right time with groups like, Dave from HF0 and others who are really focused around changing the way that we fundamentally think about building businesses and attract the kind of people that we see as being the scions of these next sets of technologies. And so I'd say it's almost this kind of recurring feedback loop, right? Where we try and help as much as we can. We do the work. Founders recognize that and make introductions based on that, both to other founders and to funds, which helps us create this ecosystem around us of really high quality people who have been successful in these and other spaces and are happy and able to lend both their expertise, their time, and their insight.
And what you'll see in the way that we've approached this strategy is that what we're trying to find is managers within our network that have two really distinct skill sets. The first one is the ability to use AI to get businesses to profitability faster, to that kind of scale faster, which is one portion of the thesis. But the other portion of the thesis is really important, which is that we're looking for funds for managers that have deep technology expertise in doing the hard stuff, the stuff that's not just building some kind of consumer platform, consumer network. These are fund managers who have been building leading edge technologies their entire career. So whether we're thinking about things like biotech and the ability to have the venture network that Catalio was built within biotechs of all of these PhDs all around the world, or things like in Playground, being able to have this ability to work with technology leaders that are doing the hard work, the things that are truly moving the world forward, and jumps in things like semiconductor technology, energy technology, the way we move around the world. So it really is two very distinct skill sets that we're trying to solve for as we're building out this portfolio and really getting to know the managers and finding which ones have the ability to be able to deliver those kinds of results.
And I'll just put a finer point on that with respect to the thesis for NVO. It's really a recognition that the boom in AI tools and this new tooling available to founders, really, we believe will create two successful archetypes of founder. And frankly, two successful archetype of fund that will support them. On the one hand, you have incredibly capital efficient business models becoming infinitely more capital efficient as they're able to take out costs and create operational efficiency. We believe that these founders will also need a fund that is able to teach them, to Cameron's point, how to scale efficiently and thoughtfully, how to get to profitability faster, how to, spend money when it makes sense and for the right things that will be accretive over the long run, but to be really thoughtful and to take an almost kind of business building co-founder like approach to how they're thinking about building these businesses. The second kind of successful archetype of founder are those that I would say are tackling the next set of scientific and technological problems of our time. These are things like quantum computing and next generation compute, things like advanced applications of cybersecurity and blockchain, things like hard tech and areas that, frankly, we may not be as focused on, like the automation of processes that, frankly, are incredibly manual, whether that be making bullet primer or thinking about how you go about mining on a practical basis. This is a recognition that those kind of founders who are changing these technological paradigms will also need a VC that is custom built for them, that understands the challenges that come with changing the basis for technology, that understand the challenges that come with introducing that technology and getting adoption, which is a key focus as we think about some of the largest failures in some of these spaces. There's some chips, for example, that have been incredible on a consistent basis, even better than some of the things that have come out by NVIDIA. But the issue has been that the adoption has not been there. And so the ecosystem around them was not able to be built out. And it's a recognition that you can find firms and people at these firms who have spent their time building these businesses, have been successful, and want to spend their time now helping new founders change the paradigms that they set in place. And what we built here, I'd say, is just a combination of these two sides of the barbell. I'd say that if you were to say there were a third leg of the stool, it'd be really a representation and a recognition that the kinds of tools from a capital perspective are changing that are available to founders as the tools that are available from a business building perspective to founders are changing. And what I mean by this is you'll see things like some venture debt, right? It's very sector specific in the case of this portfolio, biotech only, on a recognition that SVB made up north of 50% of that entire market. And there hasn't been a player, let alone a science specific player, that was able to step in and really take advantage of that. That's, things like incubations with groups like Juxtapose that are really day zero, almost co-founders saying, hey, we know there's an opportunity here. Let's go see if we know the right person to go after tackling it and helping them build a business. And really what we've built is a portfolio of these funds which represent, this next wave of how to build a business. And on a fundamental basis, I think what you're getting here is access to a very thoughtful kind of concerted group of just really high quality managers that are very targeted and focused on exactly what they are doing, which we believe in concert create a really great access point to early stage venture as a whole.
One of the things that's been really incredible about working with NewEdge is that we are so networked into this space. We were on a call the other day with a really top tier founder who's already had an exit, and just a number of people that we knew, VCs, other founders that were connected to our firm, was amazing. And unless you're part of this community, they will not let you in. I mean, it's really that simple. Like you have to they have to look at you and say, okay, you understand us, you're going to support us. And they really do not like traditional finance. They hate them. So there's a little bit of, in order to get the access, you have to, kind of be in the cool club to get there. I mean, you really do. I mean, it's the last 5 years we've really, kind of gotten deep into this space, and we know a lot of the founders, and partially through just being at NewEdge. I mean, NewEdge has really opened up a lot of doors, Maxwell and Cameron specifically, for our team and for our clients to get access to these things. And so it's very exciting. It's not something that when I was back at a big firm that I never had access to stuff like this, ever. And I think I did some stuff on my own outside of it. Greg, I mean.
Yeah. No, I was going to say, look, Pat and I are not big product people. There's very rare that we get really excited about selling, but this is something both, as clients ourselves, because we're invested in the fund, but also something that we can bring to clients, because when we see something that really offers, it's a unique access to really good managers. It solves for the problem of diversification, which is a risk because it's a volatile asset class. You get a really wide range of exposures of good managers, and you get a feeder fund with no additional fees. And we're always talking about the importance of efficiency and fees. This really hits all of the things that we look at. And so, like I said, it's rare that we get really excited about a product, but you guys have created one that we are.
And we made a very conscious decision of saying, in order to make sure that we are aligned with clients, that we're sitting on the same side of the table, that this is not about selling a product. This is about building a vehicle that provides differentiated access. That's why we did not add added fees. And the big contrast between NewEdge and other firms in the space is that what you'll find is a lot of fee additions, which ends up being that even if the underlying funds generate outsized returns, it all gets whittled away by these fees. And so in order to make sure that we maintain our objectivity, that we maintain sitting on the same side of the table as you, that's where we built something that is incredibly unique in this space of all of the work of the manager selection, all of the work of the due diligence, all of the confidence that we have that we are looking and aiming for that top decile of managers is not coming with an additional fee burden, which we think is really powerful for clients in trying to build this kind of access.
Very well said. And just to finer point on that, when Greg and I place clients in this venture fund, we are not paid 1 penny more than if we put you in municipal bonds. When we're out competing with most of our top competitors, they're either selling their own product, which is a massive conflict because you're going to collect the fees and carry yourself, which is massive conflict. I mean, that is selling proprietary products, or they're selling you their own fund of funds where they're taking carry on top. Right. And that carry takes away all the outsized returns you're probably going to get if they pick the right manager. So it's just stupid. And I personally think that technology, the same technology we're talking about that's going to disrupt the world, is going to disrupt our world. And people are going to demand, they're going to demand that their financial advisor in 5 years, this is our thesis, be pure, only work for them, not ever get compensated more on this than this. And I think that's the way the world's going, because there's absolutely no reason for a firm to charge carry on top of these things. There really isn't. And I think what we're building is the RIA of the future with low to no conflicts. We're really trying to do the right thing for the clients, and we're really focused on outcomes.
Well, that was great. I mean, I think the punchline here is it's clear ventures is a super important, building block in long-term portfolios, but it's very difficult to execute. It's difficult to find. And I think at NewEdge, we've worked to put together, a really good solution for that, which we think is a fantastic fantastic solution.
And we're all investing in it personally. We already have, just for the record. So it's not like, I mean, this is the best venture fund that I personally have ever looked at. And I've looked at a lot of them. And I will just say this one thing. If you want to understand what we're doing today, if you go to Barron's, there's an article about a really large 50 billion plus venture fund that claims that they're going to find the next 30 unicorns and da 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 da. I can just tell you right now, they will not. They're going to underperform the S&P 500. It's a giant fee grab, and it's basically selling you hope. And there's no chance you're going to outperform in a $50 billion fund where you're paying, 3 and 30 with a zillion other fees inside. You're going to underperform after tax big time. And so that's not what we're focused on, but you will definitely get that pitch from your friendly neighborhood mega bank. They will be showing you that product. You probably already have, right? And again, that's the kind of stuff that that's the past. Okay. The future is going to be, when you're going to buy a draw fund, it's going to be really nichey. It's not going to be some big broad thing.
Thank you guys so much for joining us. I think this was a great session. Appreciate it.
Great to have you both at NewEdge Wealth. Thank you.
Awesome. Thank you guys.